All right, everyone. Welcome back to the show. Thank you for joining us for another episode of the Full Subjects podcast. Today, we will be doing our year in review episode. These ones are always fun. We reflect and kind of poke fun at our own predictions and recap everything that's happened in the real estate world in the Fraser Valley and Greater Vancouver area over the last 12 months. We'll talk about things like policy changes to homebuyer plans, PTT, all that good stuff. So yeah, thanks for joining us for another episode. Friendly reminder before we hop into it, this podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or any other advice. It's not intended to cause or induce breach of any existing agency agreement. And as always, if you're not subscribed, please make sure to do so. That way you get notified as soon as an episode drops. And please leave us a 5-star review. We really do appreciate it. And let's hop right into the show.
Alrighty, guys. So as Austin mentioned, we're going to do a little bit of a year in review. This wouldn't be a normal podcast for us if we don't talk about rates in some capacity. So we'll definitely talk about what happened with rates. Obviously, the big story is what's happening or what has happened with variable rate mortgages. I was just looking back at some rate sheets today too at where fixed rates were sitting at the start of this year, just to kind of compare where we're at now. So we'll talk a little bit about that. We're going to talk about policy changes. I think every single policy change that we're going to bring up today is something we have had an episode on or we've talked about in an episode before, but we'll talk a little bit more about that. And then we might just do a quick recap of some of the episodes that we did this year and some of the awesome guests that we had on. So without further ado, Austin, let's talk about some rates.
Yeah. Did anything happen with rates this year?
No, I think everything kind of just remained the same from what I remember. I don't know about you.
We might have had like one episode a month or every 2 or 3 weeks about rates. But anyway, let's be serious. Cole, what happened with rates this year?
So not a lot happened right away. And I think that's what's important to note here is we didn't see changes on the variable rate side until June. Everything kind of remained the same. I don't have it in front of me here. I only have the rate changes in front of me, but we may have had one rate change at the start of the year, or if not, it was just at the end of last year where they actually pushed rates up again. But then they held steady for, I want to say like about 4 announcements in a row. So that would equate to about 5 months or so. I think Austin's going to do a little check here, a fact check for me.
Yeah.
But,
yes, I am. The last increase was July 12th of 2023. There was a bunch of holds, and then the first drop was in June.
Okay, so we had almost a year of holds then, which is good. I mean, I think that didn't necessarily do a whole lot to the market. It kind of just allowed people to understand where we were at, but that's not why we're here. So before I go into all the different changes we saw, because we've talked about this quite a bit, let's talk about what our predictions were, because I think this is really worth noting. So I'm going to talk about my prediction first. So we listened to the episode and these are the things that we thought. So I thought we'd see the first rate cut in April. And I was wrong. It came in June. And I thought we'd see 1% overall this year. And I mean, we saw a lot more than that. We saw 1% drop in the last 2 announcements. In the last 3 months, we saw a 1% drop. So overall for the year, we're looking at 1.75% on the drop. Cody guessed that we'd see April as the first one. And I don't have his overall here, but I think it was around the same as me, 1%.
Yeah.
And then Austin, do you want to say your own here?
Yeah, I'll hop in. So I was, I guess, the most wrong. Thanks, guys. Two different ways. So I thought the total drop was going to be 0.75. It was 1.75. So I was just a full percent off. Don't worry about it. Or 100 basis points. Don't worry about it. But I was closest, I guess I would say, when the first drop was. So I was the most pessimistic, I guess, on the length. I thought it would be July, and it actually happened sooner because July is closer to June than April is. Chicken dinner for me on that. And I guess, Cole, you were closest on the on what the rate was going to be because you took the over of me. So you were closest on that.
So here's the good news about all of this. We were both wrong about the entirety of the drops. So from a mortgage borrower perspective, anybody with a variable rate mortgage or home equity line of credit is really glad that we're wrong.
Yes.
And then in terms of when it happened, that's always kind of hard to predict because and I've talked about this a few times, most of the time the decisions are based on what's happening within the economy. So they kind of have to wait until they get to a point where okay, now it seems like the right time to do it. And they decided June was the best time to do that. And they've made a drop ever since. I won't talk about what we think is going to happen in the new year, because we're going to save that for another episode. But we may see more rate changes in the new year. But we'll give our predictions for that on the next episode. So overall, we saw variable rates come down quite a bit. I'll talk about fixed rates here in a second, but what's important to note here is that variable rates as of today are still a little bit higher than fixed rates, depending on the type of mortgage you're looking for and depending on a few other factors, but they're very close now. So you're definitely starting to see more people leaning towards that option, especially because they anticipate that rates may fall further. And because of the flexibility that variable rate mortgages offer, your penalty to break one is always going to be not always going to be cheaper, but it's never going to be more expensive than a fixed rate mortgage. And often you can convert it to a fixed rate without paying a penalty. So all really positive things for people. And ultimately, that's kind of what I wanted to cover on the rate side. Is there anything you want to talk about on the rate side, Austin?
No, I think like you kind of recapped at the beginning, it was some more substantial drops, and there's some reasons for that. I still think that there's some change ahead, but you tune in each week so that we can kind of cover it and break it down and kind of give you our take on what's going on and how it'll affect you. So yeah, very well put, Cole.
Yeah, absolutely. So let's talk about policy changes. There's been some major policy changes throughout the year, some more recent and then some kind of earlier on. So I'm going to talk a little bit about the more recent ones. So one of the more recent ones, which happened just this past week, were two really big changes. They apply to insured mortgages, and then they apply to first-time home buyers, as well as, I guess, newly built homes. So there's kind of a few factors, but let's break it down and let's make it a little bit easier. So the big things are insured mortgages for first-time home buyers, insured mortgages, you can now do 30-year amortizations for first-time home buyers. As well, if you're buying a new build and you're not a first-time home buyer, you can now also do a 30-year mortgage. That one I think is quite significant because of the fact that you and I have had to think a whole episode about this, where people aren't able to complete on their condos right now, their newly built condos, because maybe they can't get the financing they need. That extra 5 years now brings that monthly payment down and might help them qualify for that mortgage now. So that might shift a little bit in terms of what people can now afford, especially on their newer condos. So we might see a few less assignments now that people can afford them, as well as we saw some big changes to stress tests this year. And it's not that there is no more stress test, which would be great, to be honest. It's that now when you switch lenders at renewal, there's not always the need to go through the stress test. And I say not always because certain lenders are handling this differently. So I don't want to get people's hopes up too much. But ultimately, it's supposed to make it a better environment for people when they renew, so that they're not having to stick with the current lender because they can't afford to switch lenders from a financing perspective. So more competition is good for the consumer. It means they have more options and they can get the best options available to them. And the really big thing about this is it gives you the opportunity to talk to a broker and see what options are out there instead of just signing a renewal offer with your current lender, which I don't recommend. If that's the best option for you, absolutely, let's go for it. But if it's not, let's at least look what else is out there. Let's talk about another policy change that I think is a good one to talk about. It's going to be the change to PTT. And Austin, you can speak to this. Now we have buyers that can actually purchase something in Vancouver or in the lower mainland and actually get an exemption here. So I'm sure this is a big topic you've had with some people. How many buyers, if you had to guess this year, were able to take advantage of this? And not to put you on the spot, but like, would you say there's a significant increase in how many people are now able to take advantage of this?
I wouldn't say that it's necessarily like, more people to take advantage of it. Well, so let's talk about the change first. So basically the changes of PTT, and the exemption of it. So it used to be that anything under 500 grand, if it was your first purchase, you'd be able to be exempt of PTT, which would be $8,000. And that is a cost that cannot be worked into your mortgage. That is a separate cost. So if you purchase something for $499,999, you would not have to pay PTT on that purchase. However, if you purchase something for $500,001, then all of a sudden you would be over that threshold, and the property transfer tax on that would be $8,000, which is, a significant amount. If you're thinking of the minimum down payment to get into a $500,000 purchase, it would be $5% for every 100,000 that you borrow. So again, 25 grand or 5 grand per 100,000. And 8 grand on top of that. Now all of a sudden your down payment requirement goes from 25 to 33 grand for all of your costs all in, as an example. So they've changed this to a higher number. They changed this to the portion under 500 grand is now exempt. And then basically you only pay on the difference of 500 and above. So I remember when this happened, we had a bunch of people scrambling to extend completion dates and move things till after the deadline, because if you purchase for 505,000 on, I can't remember what day it became effective, but if it was before that and you closed within a couple of days of it, if you extended your completion date a couple of days later, you were saving $8,000. So I remember that was a bit of chaos when it came through. Maybe in hindsight, they should just, make that stuff effective for, when they announce it.
Right.
But then also too, all the people that we had people that completed like a month before, they're like, hey, can we get this exemption? And I'm like, definitely not. I don't think it works like that. They're not going to write you a check for 8 grand after. Sorry. But anyway, that's beside the point. So that was a huge, huge change. I think that it will slightly the cost for getting into a place, I think, will definitely kind of dictate what you're able to get into, like down payment wise, and what's going to be required, as well as, mortgage wise, what they can qualify for. But I think what's going to happen more than anything else is maybe that's an extra 8 grand that can go towards their down payment, or something like that. I think it does make a small change on the financing end. I'm sure you can chat about this more than me, but yeah, I think it's a great change. This was in place when this came into place. 500 grand would get you a lot of home. And now it basically, at least in like Langley as an example, you're probably getting like a 2-bed, 1-bath at the most, depending on age, or like a one bed and den for under 500 grand. So all of a sudden, something that was supposed to be for like a more premium product kind of thing for getting into the market now only applies to like your super small stuff. So I think it was a welcome change that I think made a lot of sense. It was probably long overdue.
Yeah, no, absolutely. It's especially in the market that we live in, where home prices are just significantly higher, like you mentioned. It wasn't fair, I guess, because portions of Canadians couldn't take advantage of that. And when I say take advantage of, what I mean is utilize those programs in order to save themselves some money, especially because they're meant for first-time home buyers. They're not meant for every buyer. They're meant for people that are trying to get into the market. There's also an increase to the exemption for newly built homes as well. It went up to 1.1 million. And Austin is absolutely right. It's not a full exemption. It's an exemption on the first 500,000. So that is really important to note. So it won't cost you $0, but it'll cost you a lot less. So that's nice. Mm-hmm. So yeah, that's one of the other changes. One of the other ones, we saw a change to another first-time homebuyer program called the Homebuyers Plan. What the Homebuyers Plan is it allows you to take money from an RRSP, so a registered retirement savings plan, and use that for a down payment. Again, if you're a first-time homebuyer, the limit previously was $35,000 per borrower. Now it's $60,000 per borrower. So that's up to $120,000 for 2 people. Really important thing to note about this is you do have to pay the money back. You don't have to pay it back all at once. You have time to pay it back, but it does effectively become a payment for you in the future. And what I'm doing with a lot of clients right now is leveraging the first home savings account and actually moving money from an RSP to the first home savings account as much as we can, because then we get that money tax free and we guarantee that we don't have to pay it back. So really important to know how to utilize these different plans. And as Austin would nicely probably say right now, this is why you talk to the professionals. So I'm going to take that from you, Austin. But yes, let's talk about another one, Austin, because I want to get your take on this one. And funny enough, I had not a personal experience with this, but I saw a place that was recently purchased and they've flipped it and they're now looking to sell it. And this is the anti-flipping rules. So the new anti-flipping rules, which I'm actually going to ask you, Austin, to go into a little bit more and do your best to explain it. We can look up the more details of it. But basically, they increase the time. Is that right?
Yeah. So they've changed this from 1 year to 2 years, as well as changed the tax rate of things that are sold in under that time.
Yes.
I'll be honest with you. I think this is more of a, I don't want to say inconvenience because that's not fair, but it's for your average person, I think it's going to like be more of an inconvenience because situations for people change. This was intended to basically stop people that would or buy a place, reno it, put some money into it, and then flip it for like, way more, as an example. You're just not seeing people do that. It's not really necessarily the market for it. So I think that all this does is basically like, inconvenience your average person more than anything else. If their situation changes and they want to or need to move, now all of a sudden they have to wait or else be taxed, which again is kind of a pain in the butt. There's some different scenarios where you can get out of paying this tax if you're, health situations, personal situations. Divorce would be one as well. And again, with that, you're probably going to need to talk to an accountant or talk to a lawyer to make sure that you would be exempt from this. But I'll be honest, I don't really think that this affects a whole lot.
No, but so that example I was talking about is there's a house not far from where I live. And I was just looking up this tax. It goes into effect on January 1st of this coming year. So it's actually not in effect yet. And they purchased, Austin, you could look this up, but they purchased, I want to say less than 2 years ago, based on what I've seen by walking around that area. And they flipped the house, essentially renovated the house, and they're now trying to sell it. But they listed it probably start of November. So it looks like they were basically trying to slide in before that January 1st date. Nothing wrong with that. By all means, you should not take advantage of, but you should realize what's coming and plan accordingly. So there's nothing wrong with what they've done. But Austin, you're absolutely right. We're not in an environment where there is lots of money to be made by flipping houses. And honestly, buying a house and then waiting 2 years from now, that might be better for you anyway. You know what I mean? The market might be in a better spot then, and maybe you're in a better position to sell at that point anyway. But I understand the underlying reason for it. They don't want people coming in and just buying up houses and flipping them and turning that into a business. But I don't know how much that's going to affect the average person. I think it's more going to affect people that may have to move but don't qualify for an exemption, and they're going to be annoyed that they're paying a tax that they shouldn't have to pay because it's really out of their control. I think that's going to be the biggest inconvenience more than anything else.
Yeah, just with when it comes into effect, I personally haven't really had many people kind of dealing with this directly. And I think the question, even with your scenario, is it 2 years from when a contract is written, so if they're trying to sneak stuff in, or is it 2 years from completion, right? Because if
I'm guessing it's completion, right?
So unless they give the keys to somebody by December 31st, then that would probably apply to them. And again, I don't think it's going to do a whole lot other than just like when people's situations change, now all of a sudden they're going to be trapped, for lack of a better word.
They can't move because of the additional cost to move, essentially.
They can't afford to move.
Yeah, they can't afford the additional cost that's going to be, which is silly. But anyways.
So like hypothetically with this, let's say you bought a place, you get into it, you lose your job, situation changes, stuff like that, which again would be awful, not minimizing that. But now all of a sudden, if you feel like you need to sell your place, you can't. Or if you do, you'll be taxed heavily on it because your situation changed, right? So, I guess
the good news with that is if you lose your job, and I say this jokingly, is your tax bracket's now lower because you don't have any income. And I say that jokingly because I'm not trying to make fun of anybody when that situation happens. It is I understand that the tax is based on how much income you make. So if you don't have any income, maybe the tax isn't as bad. Again, trying to make light of a situation here. Don't get me in trouble, but
I'm going to absolutely carve you after the episode.
We're going to make some clips of that and I'm just going to get absolutely canceled.
Yeah. Can't wait to throw that on TikTok.
Let's talk about, I do want to talk about tenancy changes, Austin, but I want to finish with that one because I think that's the most significant one, arguably. Let's talk about the secondary suite incentive program. We did talk about this. I remember talking about this with both you and Cody. Just some quick highlights for this. Basically, what they're trying to do is incentivize people that own detached homes to build secondary suites, offer them at a lower rent cost than, not a lower rent cost, but like what's the right word for rent protected cost, basically, right? Like not being able to offer rent at whatever price point they want. There's certain limits that they're allowed to offer it at. And when they do that, there's some incentives they get some money back for offering those units for rental.
It's for subsidized rent, basically, right?
Thank
or
you.
not subsidized, but below market rent.
Yeah,
Apologies.
exactly. Below market rent. The big things here is you have to have a gross income under 209,000, which doesn't sound that like that's not an insignificant amount of income, but in where we live now, like a lot of people have to have that kind of income, especially if they're going to own a detached homes. I think a lot of people won't fall into that category because of income. The house has to be assessed under 2.15 million. Again, that's quite a lot, but depending on where the house is, that's not a lot. If this is a Vancouver home, like there's a good chance it
You
could
just find at that threshold. Yeah.
Yeah, exactly. So, and you can't rent the suite out to family. So you can't just build the suite and then have family live in it at the discounted rent price. So
Yeah.
it seems like a good idea in terms of trying to get more rental units out there, but I'm curious how many people will take advantage of it. If I'm not mistaken, they announced that they're going to actually throw more money at this at the latest, what was it, budget announcement when Chrystia Freeland decided that she was no longer going to be employed. But anyways, let's not get into that, Austin. It's
been an eventful week. We'll leave it at that.
That might be another Roman episode, actually, as we can kind of talk about in the new year what's happened in December with all the different political changes. We actually might have some breaking news in January, right?
Yeah, well, there was even an announcement today, and I don't know if that's going to trigger an election, but yeah, let's maybe do it. We'll do another episode on that because that's that we could definitely get full 25-30 minutes out of.
Yeah, look at us planning ahead already. Sometimes we like to plan live on the show.
Yeah,
not always
yeah. Believe it or not, guys, we do prep work here.
Sometimes we do it on the show, but
yeah.
Anyways, so let's talk about the big one. It feels weird talking about these things without Kyle here because Kyle is our go-to for anything tenancy rental related. But Austin, why don't you take it away with some of the changes that we saw from...
Yeah, so we have it in our notes here, guys, just to let you behind the curtain. Tenancy changes, aka Kyle's nightmare category. So yeah, there were some pretty substantial changes when it came to ending tenancy. So they increased the amount of notice in order to end tenancy. They also increased the amount.
Right? Didn't they?
Yes.
Sorry to cut you off. They increased it, then they decreased it.
Yeah. So they increased it to 4 months because that's what they wanted to do, and then they realized that buyers couldn't get a rate hold for that long. So then they decreased it to 3 months, 3 months of notice. Then the other big change was there's now a website, like a portal, basically for generating notices to end tenancy. So that was a pretty substantial change. And like Kyle has said, and he's our resident expert on this, I think that's for data collection more than anything else. They want to know who is generating these notices to end, how frequently are they happening, and they're going to use that data to make decisions going forward. If a landlord is to give notice in order to end a tenancy, it's now required that the landlord or the immediate family member who will be going into the home or the unit is required to stay there for 12 months as opposed to previously it was 6. And then again, if that person does less than that and they were to file like a complaint basically against the landlord, if they rented it out before then, they've also planned to basically increase the amount of damages. So that's pretty substantial. And yeah, and then as well, you have it noted that there's limitations on landlord ability to evict tenants to convert unit to a non-residential use.
So how do you interpret this? Because I interpret this, and I didn't do the research on this, so I apologize. I interpret this as, hey, I've got a rental unit in my place. I want to convert it to a business, because that would be non-residential in my mind. Like, what else? Is that how you interpret it? Or?
Maybe people running their business out of a basement
suite.
That's
what I'm thinking.
I'll be honest. I don't deal with a lot of that.
Right.
But,
that's my assumption, is basically instead of taking away a rental unit for a family or for whoever and converting it to a business, they're making it harder to do that, which I understand why they would want to do that.
That makes sense.
Yeah. Like if you're going to have a business space, you can have a business space, but you can't take away from the rental market. That's my interpretation of it. But again, I apologize. I don't have more info on that one. Yeah, so far we've talked about rates and kind of what happened, especially with variable rates. We didn't touch on fixed rates too much. And then kind of some of the big policy changes that we've seen. It's likely we're going to see more policy changes next year. That's to be expected. We might see a new government next year. So who knows what we'll see. New federal government, that is. But do you want to do a quick recap of some of the guests we had on and maybe some of the episodes that we did?
Yeah. first off, I guess we want to say thank you to everybody that listened. You guys are the best. The feedback we get is why we do it. We love hearing that people are learning from us or being informed or just want to hear our opinion on what's going on. So we always appreciate that. But of course, the people that really, make the show what it is. Jeremy Kalanuik, we had him on. He was our most listened to episode. Found that out from our Spotify podcast Wrapped a couple weeks back. So thank you to Jeremy. That was a great conversation, just talking about him in the business and what he does and how he does it. One of my favorite humans, one of my favorite realtors. So thank you to Jeremy. Kyle Grant, who we've had on so many times just to talk about everything that we've already talked about today, all of the tenancy changes and anything that's going on. Kyle's our guy when it comes to, tenancy or government changes and his interpretation. He's one of the smartest people I know, and just his ability to articulate what's going on and explain it is second to none. Daniel Wenzik in the finance division, let's calling it, talking about, rate predictions, how people can get ahead, save more money, be better with their spending, and all of his planning that he does. Couple great guests there, and I'll let you take away the next couple people to say thank you to.
Yeah, for sure. So we had Heather Spencer come on. We talked about pre-sales, if I remember correctly, with her, and she kind of opened up our eyes to kind of that world, especially my eyes to that world of things. You guys are obviously more familiar with that than I, and when I say you guys, I mean you and Cody. And then we had Natalie Tarrant, I think is her last name. Apologies if I pronounced that wrong. She's a managing broker, if I'm not mistaken. So she's got a lot of experience with that. She specifically worked with Cody a lot and had a strong relationship with him. She actually works with him now again. And she kind of just talked about her experience in the business and different insights. The next one was another realtor, Alex Dunbar. He's awesome. Like, you and I both have a relationship with him. Obviously, that's why we got him on the show. He does a lot of great stuff on social media, YouTube especially, which I learned a lot about. So I really appreciated that conversation. It was nice to talk to somebody who does things a little bit differently, I guess, from a marketing perspective.
I was just talking to him the other day, and like what he does is just so unique. It's so different, right? Like you see these old, I don't want to say old school realtors, but like the conventional way of things used to be doing. You got a door knock, you got a cold call, you got to drop off notepads, in complexes 4 times a year, and flyers and all that kind of stuff. And just the way he does things with his systems and his technology and YouTube is just so unique. And I've learned a ton from him, not only just from our conversation, but, on the podcast, but even outside of the podcast, just getting to know him a little bit better. Another thank you as well to Chris Anderson with the One Real Estate Group, talking about relocating, people moving up to Kamloops and the interior, why people are doing it, the ins and outs of that, all the things that you don't think about. Great episode with Chris. Also from my office, Roman St. Germain, we had him on before the BC election to talk about some of the changes that were, or some of the things going on at that time. Really information. I learned a ton from Roman, and just to get to know him a little bit better about how his brain works and how he sees things. That was an awesome conversation. I'm not sure if you have anything to add.
Honestly, yeah, we had 2 episodes with him, if I'm not mistaken.
Yeah,
we did the before and after, right? Yeah. That was cool. Like, I'm not well versed in the world of politics, and he clearly is, and he cares about what's going on. And he likes to follow the elections, and he likes to kind of see what's going to happen, make predictions. And I think that's great. And I think as a father, he does a good job, because he clearly involves his kids in it as well, which I think you and I can both appreciate as fathers, is getting your kids involved and helping them understand what's going on. Even if they don't necessarily get to vote, at least knowing that they will have decisions in the future. So that was one of the big takeaways I took from him. And I definitely think we'll have him on in the new year, especially as we start talking more federal politics and getting some insights from him.
Yeah, for sure. Big shout out. I know we had them on, I believe, before as well, but to Jeff and Jen Nelson, talking about, life insurance, all the things that go, run adjacent to what we do, making sure that you're protected, and heaven forbid if something were to happen. So just being prepared and kind of understanding everything that go alongside having assets, family, all that kind of stuff. Chris how do you say his last name? That's going to bug me. Chris with Ridgeview Home Inspections. Not going to touch that. Big thank you to Chris. I learned a ton from Chris. I'm very fortunate to, be able to connect with him and his business partner, They've done a ton of inspections for me. They're always great to work with. So just kind of talking about the process of what they do and how they do it and just educating people. Because again, it's one of those things that, you kind of know what a home inspection is, and then you have one, and then you might not move for another 8 or 10 years, and so much changes. So yeah, big thank you to Chris Adam with AFK Media. I learned a ton from him just on, how he does things in tech and real estate and marketing and branding. And he's just so well versed in technology and making sure that, the homes that we sell, show the best, and people get excited when they view the marketing, and that gets them in the door, which ultimately leads to them, buying it, which is fantastic. And then last but not least, Ryan Gagnon from Royal LePage in Penticton. Great conversation with him talking about Airbnbs, short-term rentals, put Airbnb in the swear jar. So short-term rentals and how the market was affected up there. I remember, when he changed my perspective quite a bit when chatting with him. I was thinking, yeah, I'm sure the people in the town are going to want to see that because it stimulates tourism, all that kind of stuff. And he was like, yeah, sure it does. But if you're in a family neighborhood and you got a bunch of, people partying and stuff on your street from from a short-term rental that they're renting for a weekend, that's probably going to be a bit of a nuisance. So yeah, great perspective and a lot of things that I didn't quite think about from Ryan. Thank you again to all of the guests that we had. Can't wait to have you guys on it, not only again, but also diversify our guests and who we're going to be bringing on in the future in 2025 for season 2 of the Full Subjects podcast.
It's official, season 2. And I want to apologize in advance if we missed any of the guests that we had. We did our best to try to recap the ones that, not the ones that we remembered, but we tried to recap all the ones we could. So apologies if we missed that. But yeah, go look. Those episodes are all there if you guys are interested in anything. And I think each one of these, what's nice is they're all a little bit different. And a lot of these are realtors, sure, but they're all giving us different information. We're not having the same conversations with everybody. So there's little things that I think people can take from everything. And I don't think you need to be a realtor or somebody that works in this industry to gain some information or gain something useful from these conversations. So yeah, just throw it on and let us know what you guys think. And as Austin always says, please leave us a 5-star review if you do like the show.
Yeah, well, thank you guys for joining us for another episode. We'll have a couple more back-to-back that we'll be recording today. We've got our recap. We have our crystal ball for 2025 episode that we'll be recording as well. So yeah, thanks for joining us for another episode, and we will see you guys next week.